Please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
Hello and welcome to this special conversation. He's someone who shot into the limelight on Dalal Street literally overnight. And that's perhaps he was ahead of the curve. He saw the signs and he called it right. At a time when corporate governance lapses and auditor resignations have rattled investors on the street, he's someone whose market opinion has now become very sought after. And that's all thanks to a blog that he wrote on a company called Manpasand Beverages. So who is Amit Mantri? What prompted him and his associates to undertake this kind of research? And more importantly, what are they up to next? That's exactly what I'm about to find out here. Amit, welcome to this show. Thank you for taking out the time and talking to us. I mean, you would pretty much know, right? We keep following what's happening on Twitter, and these days it's resignations and scandals and what's going on and what have you and what not. First of all, there's a lot of media attention, scrutiny upon you from not just us, but people within the fraternity, mutual fund houses. So the usual question, how does it feel? Aapko kaisa lagta hai?
So it feels good and scary as well. Good because there has been a lot of attention. People are now finally reading a report that we had put out 1.5 years back. So maybe a bit delayed, but we are fairly happy that it's being read now. Scary because I think now people are starting to read into every word that we are uttering, which probably is not healthy.
Why do you say that?
At the end of the day, even we are people who are doing research, and just like anyone who is making investments after researching them, eventually we will also get things wrong, and we will also make blunders when we are investing. And if you're just blindly following anyone's opinion, you will probably end up losing a lot of capital on the Dalal Street.
Well, right now the magnifying lens is on you, so
Definitely.
let me get some more details out. Now, just to tell you guys, Amit, along with his colleague from IIT Kharagpur, Surabhi Jain, right?
Yes.
Surabhi is his name.
Yes.
Started the company called 2.2 Capital. It's a PMS, SEBI-registered PMS, and you're in the business of stock picking. So tell us, I mean, how did you come to this position, and really, I mean, what your mandate is right now?
So we started 2.2 Capital back in 2016, and one of the main things that we were seeing in the equity markets was there was a significant lack of awareness about governance risks that exist in companies. And this is not just related to small caps, mid caps, or large caps. We were seeing that across the market pretty much. So for us, the focus area was if we can minimize the blunders, if we minimize the blow-ups that can happen in the portfolio because of your inability to understand whether the numbers are real or not, in the long run, you will be able to deliver better returns for investors. And that's the idea behind which 2.2 was started with. And it's now been close to 2 years. We've stuck to that, doing a lot of research when we are investing, spending a lot of time on forensic analysis of financial statements. And we come across multiple cases where the numbers just don't add up.
You have made a lot of people in some very well-established broking and mutual fund houses quite uncomfortable. Let me actually start by understanding this. A lot of people will ask questions. Is there some kind of a personal interest? Is there an agenda at play? Did you seek the company's comments, all the companies that you're analyzing? Do you seek their side of the story? And why essentially are you doing this?
Yep. The reason we are doing it is because we enjoy the research part, just finding out problem areas. And there's a lot to learn from even companies which are not doing that well. So while you can keep studying Buffett and Munger how to find great investments, it's also as important to identify bad investments and to stay away from them. And that's been the goal behind doing this work.
Let me ask you this. You don't have investments in Manpasand, from what I understand.
No, not at all.
What about the other company on which you wrote a piece, the curious case of Kitex Garments?
So even on that, we have never had any position.
Okay. I think the most critical question of this conversation, there seems to be a bit of an Amit Aya syndrome in the market, because I keep getting text messages these days. The other day, there were a couple of stocks that were down, and the buzz was, oh, is Amit writing something on them? So please set the record straight. Are you analyzing any more companies or any more stocks at the moment?
So we continue to analyze stocks all the time, basically. But the reaction that is coming in, that whatever you referred to, I think that's significantly exaggerated. There is really no reason for that kind of scrutiny of what we are writing or what we are publishing on Twitter. In fact, we will now be weighing our words very carefully even when we speak on public media or even when we write on Twitter, because so far no one has been paying attention for.
And now everyone is paying attention. Absolutely. But so, are you working on another company where you are looking at corporate governance issues? Is there something in the pipeline along the lines of Kitex or Manpasand?
Not at all.
Nothing as of now that you're writing on. Not even, let me actually ask you straight up front on this, because we did speak to some of the managements, for instance, Shankara building projects, and that stock has been down for the last couple of sessions as well. So any such conversations with Shankara that have been built on these kind of lines?
We're not publishing anything on these companies right now.
Okay, fair enough. So now let me start with the story, the Manpasand story, and things are quite interesting. In case you haven't read the blog, let me quickly run you through a brief synopsis. So Amit and his team raised some very interesting points, and this is at a time when Manpasand Beverages was, a market darling in terms of how the stock was performing. You raised some issues which actually were very commonsensical as well. For instance, you raised an issue on the basic growth numbers, that if this company doesn't have a very big distribution reach, if Coke and Pepsi are the biggest distributors in this country, then how is it actually able to generate the volumes? You raised some questions on the kind of contracts that it had with the Indian Railways. And I think another question that was very relevant was, how is Fruit Ups, which is a brand owned by Manpasand Beverages, how has that become bigger than Appy Fizz? And Appy Fizz is a category leader in that particular type of beverage segment in less than 2 years, and lesser advertising spend obviously by Manpasand as well. And then some big red flags as well: low employee compensation, things like promoters engaging in related businesses in separate entities. I'm just surprised that, how did a lot of this miss the analyst fraternity?
Not sure if they completely missed it. I think the analyst community was believing management's word on pretty much everything in this case. There was very little questioning of whether what the management was saying could actually be true or not. And I think there was very little independent diligence that was being done. So in fact, the way we probably figured this out was, for us, even the fact that they were generating so much revenue from the Indian Railways just was not adding up. We were just trying to do a basic back of the envelope calculation, and the numbers were just not adding up in many cases when it came to Manpasand. And that's when we decided to, let's spend some time, let's do some surveys, let's ask consumers whether they are actually using this product.
Were you looking at adding Manpasand to your portfolio at some point in time? Is that how you started researching it?
Yes. Okay. So that's really how we came across. So at the end of the day, it operates in a segment that's quite interesting. Beverage consumption should be increasing, and this was a company which was reporting phenomenal growth. So I can understand why the investors who were buying the stock loved it. Even we would have probably bought it for the same reasons as well. It had great ROE numbers that it was reporting. Revenue growth was fantastic. So of course, for us, that's not enough. What the company is reporting is not enough. You need to get deeper into it. And when we got deeper into it, we kept getting one issue after the other. We were not able to figure out, for example, when we went across Mumbai, we were unable to find the product. When we checked on any of the e-commerce websites, the big baskets, the grocers, the grocery-focused websites, we were unable to find the product anywhere. Of course, then the argument that was given by the company was that we are tier 2 focused. We are not present in metros. And our response was, then we can research in those markets as well. We can go into those markets and check them out. And when we actually did that research, we did not find any evidence of the kind of market share that they were reporting.
Sure. So, that's how the cookie crumbled, literally. Another thing that kind of really caught my attention on the Kitex blog. Kitex was a blog that you guys wrote in July of 2016. The Manpasand blog came out in December. This was really interesting. The first point itself, that how is a company like Kitex generating higher pre-tax ROCE than even a company like Page Industries? Was that the first sort of tipping point for you?
Yeah, so for us, the Kitex was a textile business. They were in children's wear, and the argument is that children's wear is some sort of a different beast altogether, and therefore you can make higher margins. For us, that argument didn't really make sense. At the end of the day, you were supplying to the likes of Walmart, Target, Toys R Us, who literally squeeze the margins of any supplier that they have. So for someone to be claiming to make 30% EBITDA margin in a fairly competitive segment, that was not, for us it seemed to be a too good to be true kind of situation.
Okay. However, having said this, the Kitex share price had already started falling by the time the blog came out, and then of course it just kept tumbling thereafter as well. There was never any recovery, 2016 and now in 2018. But the case of Manpasand was different. Shares were actually doing quite okay till the time we had this auditor resignation. So what do you make of that? That became the prick that actually burst the bubble.
Yeah, so if you've seen the price history of Manpasand, we had written the blog in December 2016. And the day after the blog was written, the stock actually fell in the morning, but it actually closed positive on that day.
Enough buyers coming in.
Enough buyers. Obviously, there was not enough attention that was given to the report, and the stock actually hit new highs after that. So the stock kept going up almost 40-50% after we had published the report.
I mean, I just want to, for the sake of viewers, I want to talk about some of the major mutual fund investors that continue to hold positions as of the latest available shareholding data on the exchanges. SBI, the Magnum Multi-Pick Fund, 4.4%, ICICI Pru Midcap, 1%, and the Motilal Focus 35 holds about 5.49%. So these are some of the major institutional investors that are still part of Manpasand.
Yeah, no, so the stock kept going up, and in fact, a lot of mutual funds kept buying more and more of Manpasand. However, what probably focused people's attention to the blog was the auditor resignation. That was really what came as a surprise to everyone. And once that event happened, everyone started going back to, oh, there was a blog that was written 1.5 years back. Maybe we need to put more attention on that.
So which is why I think the auditor resignations are now becoming perhaps the most important events. What do you make of this? I mean, just this morning I was looking at the numbers put out by Prime Database, 32 auditor resignations already so far in this calendar year.
Yeah, so I think it's a very good sign actually. You know, auditors taking a stand on that. If they're not getting adequate information, that they would rather quit than to agree and signing off on the numbers which may not be real. That's significantly positive, and I think it might be happening largely because of what's been happening over the last few quarters. There's a lot of scrutiny that's happening on auditors. In the case of Fortis, there were issues that were raised about the financial numbers. We had the case of RICO India also, where the forensic audit raised a lot of questions on the earlier audited statements. So now auditors' role is being called to question in many of these cases.
So we'll keep seeing more resignations.
I think so. I think so, and that would be a great outcome for shareholders.
That'll also mean perhaps extended mayhem in the mid-cap market. I mean, the small cap index is down 19%. The mid-cap index, I mean, this calendar year is down some 12-13%. And confidence, I mean, has seriously taken a beating.
Yeah. No, so if you have exposure to some of these dodgy names where the auditors may not be comfortable signing off on the accounts in the future, where there are concerns even now on the financial statements, you have to be worried. If tomorrow the auditor resigns, the stock will probably end up falling a fair bit. But if you're investing in good businesses and if your long-term goal is to find good ideas, the fact that now the quality of financial statements is improving can only be a positive sign.
Fair enough, but then that does mean that there could be, serious pain, at least in the near foreseeable future. And that's why I want to get your thoughts on the most important issue, how to start understanding and finding out those red flags. Because, for instance, take the example of Vakrangi. I mean, again, that was a stock that was highly recommended by large sections of the market, and we know what's happened since then. Your thoughts on Vakrangi, your thoughts on PC Jeweler? There's been serious wealth destruction there as well in a very short span of time.
Yeah. So I think the way any investor should go about is they need to really understand the profitability of a company that they're investing in, whether it's simple to understand. In many of these cases, we have seen that the company exists largely in the stock market and it does not have a real world presence. In the stock market, every investor knows them. It talks about it as a multi-bagger. It's a phenomenal business. But when you talk to consumers, they've never heard of this company. And that really just doesn't add up over the longer term. If a company is doing well, the consumers will also be talking great things about it. And you can look at all the great businesses, the likes of D-Mart, the likes of Eicher Motors, the likes of Page Industries. It's not just that the investors love them, even consumers love them. Look at the number of people who line up outside a D-Mart. Even in the case of D-Mart, for example, there's one thing that we look at a lot, which is, does the company generate free cash flow or not over a long period of time? And if for a persistently long period of time, the company does not generate free cash flow, even as it reports great earnings performance, it tends to be a fairly negative sign for us. But DMart also does not generate free cash flow because it keeps buying new properties. But there we understand the fact that consumers love it and it's investing for growth. That might not be the case in many of the other companies.
Okay, fair enough. Those are just two ways of ensuring that you're in the right kind of companies. We have a lot of ground to cover. And by the way, we need to take a break right now. Don't go anywhere, because on the other side, I'm going to quiz Amit about a series of tweets that you put out a couple of months back, which essentially says that if you are a fraudster and if you want to make money in the market by defrauding shareholders, here's how you do it. It's all sarcasm. Essentially, these are the red flags that you need to be very, very careful of. Back in a moment. Welcome back. Here with this special conversation, I am talking to Amit Mantri of 2.2 Capital. Now, Amit, I must say that these tweets that you put out on tips for a fraudster, how to defraud shareholders, it's all sarcasm. Essentially, these are, Amit's way of saying that these are the red flags that you should be wary of. Some of them are very, very caustic, and I just want to sort of go through them. You advise, this is the advice, if you want to set up your own company and defraud people of shareholder money, how do you do it? So Amit says, have a good story to catch investors' attention. Something like the only listed XYZ company in India, because it's a great branding exercise. Draw analogies to the likes of DMart or other businesses, maybe the next page industries, again, to keep the branding intact. Give aggressive guidance, that's obviously the basics. Start making up numbers. Only revenue and PAT matters. Don't worry about the balance sheet, because no one looks at balance sheets in a bull market. That's saying a lot, Amit. And that kind of makes me a little sad as well, because is it really as bad out there? And are we in that kind of a bull market already?
No, so that's been the market over the last few years, actually. So in fact, we have actually suspended belief in many of the companies, wherein we are fine with companies reporting whatever earnings they are reporting, as long as there's 50% growth year on year. It doesn't matter to us whether the balance sheet is in a complete mess, that the company is not collecting on its receivables, that there is inventory that's stuck, and that there are other red flags in the balance sheet. So I think most investors are extremely focused onto the P&L side of things. That's not ideal, but I think that's how the market has been over the last few years, pretty much, in the small and mid-cap space, pretty much.
Yeah. Then you go on to say, and in the tweets again, that again, advice to someone who wants to set up a company to defraud shareholders. This is all with sarcasm. I'm repeating that. It's just a way to let people understand perhaps the kind of games that go on out there. Raise large amounts of debt from PSU banks to fund fictitious capex, gold-plate the capex to siphon out funds. No one questions absurdly low salaries or even purchases of computers worth 20 lakh rupees per employee. I'm guessing this came from research somewhere. You did come across companies that had ascribed a value of 20 lakh rupees per employee for computer expenses.
Yeah. So, and it's one of the recent blow-ups that has happened in this.
Can you tell us the name?
So,
since it's already public, I'm guessing now.
So I don't know if you look at Vakrangi's capex that they have done in computers. I think over a 2-year period, they ended up spending almost 400 crores in terms of computers. And the company had 700 employees. So 700 employees, 400 crores in computers, that's too high a number. And for us, that doesn't add up really. How can you, what kind of computers are these? Are these gold-plated computers? Even the MacBook highest end Apple product only costs 1.5 lakhs maybe. And here we was a company spending much more on computers per employee. Though we tend to find a lot of such red flags in a lot of companies, and it's when you start seeing multiple issues with the company, there's aggressive guidance that's happening, companies diluting capital every couple of years, management is not able to explain why certain, for example, there is cash on the books, but it's not generating interest income. Why is that the case? Why aren't you putting it in some high-yielding FDs at least?
Or there's cash on the books and debt is not being repaid, which was the case with Kitex. I think that was one of the flags that you pointed.
That was one of the cases, and we keep seeing such instances, and we are surprised that not enough attention is paid to these basic red flags. So in fact, I'm not sure it was clearly sarcasm, but it was also out of frustration that we were writing it, because these are two obvious things that people are not picking up.
How pervasive is the rot? Because the kind of market that we're in the midst of, we have just come on the back of a year which gave us 45% returns at an index level, the Midcap index. How do you sum up that situation in the real world, in the real sense?
Yes, so I'm not trying to be a scaremonger here. The problem does exist. In fact, I think we've only touched the tip of the iceberg so far. And there are a large number of companies which are not operating their business to generate value for shareholders, but to defraud them. And especially in the last few years, the main rally has happened in the small and mid-cap space. That's where people have seen their money doubling, quadrupling, multiple excess on their capital. And that's where I think the biggest problems also exist, because people have, for now at least, said that all these red flags, all these governance issues, they don't really matter.
Now, I'll finally come down to the role of auditors. We've already discussed that, because that's how the bubble burst in case of Manpasand. What would you say? Because people are still left high and dry. Nobody knows the real reasons because of lack of perhaps enough transparency disclosures. What would you like to say, let's say, to either the Ministry of Corporate Affairs or the ICAI, so that we are not left in a black hole when an auditor resigns?
No, that's absolutely a fair point. I think the fact that you're resigning without giving adequate information of why you're resigning. I think in the case of Deloitte, we had them saying significant information was not provided. That's not enough for statement. If you're, after 8 years, if you're resigning from a company where you have been auditing without any qualifications in the prior years, you need to provide more reasons than that. And I think that's what the ICAI and the Ministry of Corporate Affairs needs to put down more regulations in what are the disclosure standards that need to be there. In the case of PwC resigning with Vakrangi, there actually we had much more reasons. They had given a fair bit of detail in terms of why they were quitting, what information they didn't get. That's a much better way to resign than what has happened in this case.
Well, it's been a good first meeting, Amit, and I hope we will keep hearing more of you, and we will look forward to more of your writings as well. Thank you for taking out the time today. That's it on this special conversation. Thank you for watching.